The outlook for emerging markets in 2025 is set to be dominated by debate over the impact of trade tensions as President-elect Trump returns to the White House. Sylvia sat down with GIB Asset Management portfolio manager Kunal Desai for CNBC's Delivering Alpha and asked why he is optimistic about the outlook for Chinese equities.
It comes down to the impetus and the importance of stimulus in China and why that matters today far more than it did over the last 3 years. And it's really about this 5% GDP growth target that matters. So whilst investors think that Trump coming in with hawkish Chinese policies is a negative, we actually think this can be a positive because it will force the hand of Chinese policymakers essentially to revive domestic animal spirits. And what's interesting is the types of businesses that will benefit from this consumer rebound are actually the better quality companies in China. These are businesses with high brand power, clear competitive advantages through scale economics, some element of network effects, businesses with high profitability, businesses also which are sitting at net cash balance sheets. So this creates quite an interesting opportunity of companies which have seen their relative valuations fall, but can now create a more rosy outlook for the years ahead. One such company is Yum China. This is a business which is a large position in our portfolio. It's essentially the master franchisee of KFC and Pizza Hut. And really their business model is framed by an incredibly powerful digital capability which allows them to cross-sell, drive engagement and introduce new products. What we're seeing is even though there is downtrading taking place in China, where ASPs are falling, the traffic growth more than offsets this because of the dominance they have in terms of their store expansion. They're now using this opportunity to pivot to franchising, which creates a cash unlock for the business and also driving consolidation in their individual sector. Now, this is a business which has clear competitive advantages driven by the brand, driven by the process that they have, but the relative valuations versus history are some of the lowest that they've seen over the last 25 years. So this creates an opportunity with the tailwinds that we expect for 2025.
I also noticed in your top 10 holdings, at least in the month of November, you had JD.com and Trip.com. Explain to us, why are you so bullish on these names? Why do you own so much of these names? What is the trend there?
One of the most interesting aspects we're seeing now from China is the capital return story. So when we compare China versus other emerging markets across the world, China has two aspects which we think are particularly attractive. It has the highest cash percentage, a percent of the balance sheet versus other markets around the world. And the payout ratios of companies in China is significantly lower. So what we believe over the next 18 months is a really powerful dividend, buyback, capital return story to come through in China, which is what we've seen actually in the US over the last 4 or 5 years. JD.com is one of those businesses that benefits from a consumer rebound. It's the leading e-commerce company in China, but the capital return story is something that we think investors have ignored. So this creates an attractive dividend growth story, which can again provide downside protection for investors. Trip.com is a beneficiary of outbound travel. So even though Chinese are consuming less, actually consumption priorities have changed. It's moved away from luxury, it's moved away from some forms of goods towards services, which is what Trip.com provides and leads on.
Sylvia also asked Desai about his interest in Indian stocks.
This is probably one of the most attractive secular and scalable investment opportunities globally, including developed markets as well. Really driven by monetary sovereignty, driven by corporate return on equity improvement, driven by a private capex cycle, which we now expect over the next year and a half. And it's a market which also has geopolitical positioning, which is favorable in this Trump 2.0 era. In terms of companies which we look for, are typically mid-cap companies which we believe, again, can scale to become blue-chip companies of the future.